Hello. With me today is Mike Fox, manager of the Royal London Sustainable Diversified Trust. Could you start, please, by taking us through your investment process and philosophy?
So our investment philosophy is that the only way to maximise the risk reward of your investments is to integrate sustainability considerations alongside financial analysis. So as well as looking at traditional metrics like balance sheets and cash flows and management quality, we also consider the products and services of a company and its role in the transition to a more sustainable society and the general standards of ESG within a business. And by putting those two sides together, sustainable and financial, that reflects our investment philosophy and our process.
In an exercise of classic understatement, last year was a bit volatile. How did your risk management process deal with that and take you through the year?
So our view on risk is that the only risks that really matter are the ones that nobody knows about. So literally no risk system I saw pre-pandemic had a pandemic in as a risk scenario. So the way we think about risk is that the determining factor is how we conduct ourselves in the good times. So we tend to invest in more liquid, less leveraged, and less cyclical businesses, which means that when the unforecastable happens, we can sleep better at night.
And what's been your biggest driver of returns over the period?
I think if you looked over the last 1 and 3 years, I think it's been the digitalisation of the global economy, which was very much happening before COVID, but was very much accelerated by it. So there was already a transition from the physical to the digital world, which we think is environmentally very positive before COVID, and that is absolutely accelerated. So really on a 3-year view, if you just avoided the physical world and invested in the digital world, you would have seen very handsome returns.
How do you view the rise of ESG integration in the asset management industry, and what does this mean for sustainable funds?
The general rise is a removal of what we'd always consider an anomaly, which was that the asset management industry viewed that investing was an amoral exercise, that if it was listed by it, that it wasn't the role of investors to consider environmental, social and corporate governance issues, something that we profoundly disagree with, both philosophically, but also in terms of delivering investment returns. So undoubtedly, the rise of ESG, I think, is a good thing. It does make life for sustainable funds slightly more difficult because previously we would say we integrate ESG, that is our point of difference. Now everybody says they integrate ESG, so we need to refine and differentiate ourselves a little bit more. But the general principle is it's great. ESG should be integrated into all investment decisions.
What form is that integration and differentiation taking?
For us, I think it's really finding genuine leaders in sustainability and ESG standards that previously the level of differentiation between standards within companies from a sustainability perspective was much more limited than it is today. And now with corporates understanding that they can both raise debt more cheaply and their equity will become more highly valued if they show good ESG credentials, what we basically see now is there is much more differentiation and much better standards available at the upper end. And I think that ultimately is where we will find our point of differentiation investing there rather than across the broad market.
Mm-hmm. And how do you see the industry in general evolving, or so the ESG industry is rather evolving?
I think it will go through a period of consolidation within the next 1 to 2 years. It's been something of an arms race for the asset management industry in the last year or two, for an industry that really didn't take it particularly seriously. It's had to do a massive handbrake turn and really kind of re-engineer investment processes, had to recruit many people in this space. And I think almost the noise became too loud last year. I think, even for us who are big fans of it, even we got a little bit weary of almost every article being about ESG. So I think that needs to calm down. I think it needs to consolidate. I think it needs to be treated for what it is, something that's very valuable, but not necessarily the answer to everything. And I think if it can find its level, then I think that would be a great positive. There is quite a lot of confusion about what sustainable investing actually is. and that there's a desire to create a singular definition for it. I think our view on this is much like there's 20 different forms of growth investing, there will be many different forms of sustainable investing. And really to embrace that diversity, to understand that there will be a spectrum of sustainable funds, from very environmental funds to very pragmatic broad funds. And in the end, that's great because it will provide choice for investors.
ESG, particularly over the last year, has been very much cast as a growth play. Do you think that's fair? Where does ESG actually sit within the value versus growth debate?
So I think there is a view that companies that provide solutions to environmental and social issues, which is another way of thinking about sustainable businesses, are growth companies. They tend to create their own markets. If you can cure cancer, if you can decarbonize energy, if you can put IT in the cloud, these are huge growth opportunities that didn't exist 5-10 years ago. And that's very different from investing in oil companies or airlines or industries that were created some time ago and are really just in cycles. And those cycles can be long and vicious at times, but they are just cycles. So there is no doubt that sustainable investing at its heart is about growth. I think on the value versus growth debate, simplistically, you have a certain number of industries that fit in the value bucket and a certain number of industries that fit in the growth bucket. And ultimately, one bucket will outperform the other based on the fundamentals of those industries and their long-term prospects. What we would observe is that the growth bucket, measured from pre-pandemic, has become much more valuable, and the value bucket has become less. Now, in market terms, that may have got overshot on the upside from the downside and needs to readjust, which is probably what's happening now. But ultimately, a company is going to be spending thousands of pounds on business class airline tickets to go to conferences around the world, or we're going to be sat in front of iPads and doing Zoom calls? We think probably the latter. So there is no doubt that sustainable investing sits in the growth area of the market. We tend to find that companies that provide solutions to environmental and social issues are growing businesses. They create their own end markets. If you can cure cancer, if you can decarbonize energy, if you can put IT into the cloud, you will deliver profit growth for many years to come, and that is a good thing.